Ray Dalio is an investment titan with over 50 years of experience in the markets, and in 2022 he managed to prove himself once again as the pure alpha fund managed to rack in 20% annual returns in a year in which the S&P 500 was down by 20%. In this video, I, Bobby the Market Watcher, will discuss his portfolio, so stay until the end of the video if you want to see which are the top 10 investments of Bridgewater, the company of the investment tycoon. As always set with educational purposes and is not meant to be taken as financial advice. Ray Dalio believes we are entering a period of economic hardship, and his top investments are the proof in the pudding, as they say, as almost all of them are recession protection stocks from predominantly the consumer staples sector. This sector is more stable in hard economic times, as the products and services which are being sold are of basic need for the consumers. This makes them very sticky, as it is hard not to buy your basic food items, drinks, hygiene products or medicines. Also, it is important to note that the information is derived from the 13F filing report of Dalio, which does not include any international holdings or short positions he may have. With that said, let's start off with the 10th largest position in his portfolio, which is CVS Health, with a 1.48% share. Alongside Walgreens, CVS is the largest pharmacy provider in the United States. As of the end of 2022, the company has a forward-looking dividend yield of 2.26%. It has a low long-term debt-to-equity ratio of 0.72, which is below 1, and it is good, but I do not like the PE of 38. For me, it is just too high. The 10th biggest position is in Abbott Laboratories, which is a 1.5 share of the portfolio. This is one of the biggest providers of healthcare and medical device companies. It has a PE ratio of 25 and a debt-to-equity ratio of 0.43, which is below 0.5, and it is the optimal place to be in such a high debt and higher interest rate environment. The forward dividend yield of the company is 1.81. The 8th biggest position is Pinduoduo stock, which alongside Alibaba and JD is the largest e-commerce player in China. The company has introduced the team purchased and consumer to manufacturer concepts in the Chinese e-commerce sector. The company does not pay a dividend, as it uses almost all of its generated profits to invest in for more growth. Its debt levels are quite low for such a business, with a minor debt-to-equity ratio of 0.15. It represents a 1.6% of the share of the total portfolio. The 7th biggest position is in McDonald's, with a 2.46% share. The forward dividend of the company is 2.24. The current PE multiple is higher than the historical average, standing at a whopping 33, while the company has a negative equity, as the total assets are lower than their total liabilities. On spot number 6 is Walmart, the epiphany of the classic consumer staples stock. No matter if we have a war, earthquake or a recession, people will have to go to Walmart to shop. The forward dividend yield is 1.57, the debt-to-equity ratio is 0.48, which is the optimal level. The PE ratio, although, is 44, which for me is again too high. The portfolio sizing for Ray Dalio is 2.64%. On spot number 5, we have another classic for the consumer staples sector, and that's Costco, with a 2.86% portfolio share. The forward dividend for Costco is 0.79. Costco is also a very beloved investment of Charlie Munger, the longtime partner of Warren Buffett. The debt levels of Costco are very strong, with a debt-to-equity ratio of only 0.3, while the PE is 34. On spot number 4 is Coca-Cola with a 3.25% share of the Bridgewater public allocations. Coke has a forward dividend yield of 2.8%, while their debt-to-equity ratio could be much better as it is well above 1, sitting in at 1.74. The price-to-earnings multiple is 27. 10 years ago, the level was 10 or so. For more info on Coke stock, make sure to watch my Coke stock analysis here on the channel. On the official podium on spot number 3 is the rival of Coke, Pepsi, with almost the same portfolio share amount of 3.32%. Pepsi is valued at 25 times earnings. It has a forward dividend yield of 2.52%, while its debt-to-equity ratio is even worse than Coke, with a 2.08 point ratio. The second place is reserved for Johnson & Johnson with a 3.89% portfolio share. The management of the long-term debt is great with a level of only 0.37, while the forward dividend yield is 2.55%. Just like Pepsi, the earnings multiple for J&J stock is 25. The top position in Dalio's portfolio is Procter & Gamble, which is the only stock to break above a 4% portfolio share allocation, sitting at 4.22%, with a forward dividend of 2.59, a debt-to-equity ratio of 0.75 and a multiple of 26. It is not much different from the other positions of Dalio. As for the very important conclusion, Dalio is betting heavily on the biggest and most proven consumer and healthcare sector stocks, which all pay dividends, with the only exception being Pinduoduo stock. Comment down below if you want me to analyze PDD stock, and make sure to watch my other analysis videos on the channel. Please like the video if you learned something valuable, and make sure to subscribe to the channel to learn even more. Thank you again for watching, and I'll see you until the next one.